Let's talk to Sharan Bansal now, Director at Skipper Limited. The numbers have just come in. Pull up Skipper, it's trading higher by 7%. And if you pull up the 6-month, 1-year graph, you would see this entire space of engineering, railway electrification plays / T&D kind of business has done phenomenally well. In the last 6 months alone, the stock has done pretty well. Back to this year it's flat, but in last 6 months it has actually doubled. So it fell very sharply and has recovered. This quarter, slightly on the softer side, but let's understand what are the elements of the business looking like. Sharan Bansal is here with us. Sharan, thank you so much for your time. We saw mild pressure coming in on the margins this time round, but the growth largely is intact. Talk to us what went by. This just a 1 quarter thing. Overall, the momentum in business is still intact?
Yes, absolutely. We have delivered our highest revenue quarter in quarter 4 this year with a top line of total 657 crores. And on the bottom line side also, overall in the year, there has been a significant growth. We've delivered a 41% increase in PAT numbers from last year 25 crores to this year 35.5 crores. You might be talking about the reduction in margins only for this quarter, which are largely on account of some notional M2M forex losses, which will be corrected as when the revenues are realized. So whether it's revenue or whether it's bottom line, company has reported very good performance this year.
Certainly about 20% top line growth. Do you see, how is the visibility coming? All the 3 segments, visibility of growth, and where exactly where all are the incremental orders pouring in from?
Sure. We see excellent visibility. We have ended the year with a very strong order book of approximately 4,500 crores. Almost 4,100 crores of these came in just in this financial year itself. We are seeing very, very robust growth in global markets around the world, particularly in the power transmission space, where the investments are being led by a lot of investments in renewable power around the world for countries to meet more and more of their renewable addition targets and to move towards net zero. So we are seeing demand coming in not only from developing economies, but interestingly, we are seeing very good demand coming in from developed economies as well. Zones like North America, Europe, and Australia. Typically, we have not seen demand coming in these places earlier. But now, thanks to addition of renewable power, we are seeing good demand coming in from here. And also, the other reason for demand growth is telecom investments. The move to 4G and 5G in various parts of the world are leading to a push in telecom growth. On the last segment of ours, which is polymer, we have delivered good growth numbers this year. Approximately 400 crores this year compared to 320 last year. And we hope to continue to do better and better in the coming times.
Yeah. Sharan, that point is taken, but I was also reading your commentary and you talk about how you want the export potential to rise to around 75%. But if I look at the current order book breakup, almost 80% of the order book is actually domestic. Could you help me bridge the gap between the two?
Yes, there is a large capex push in the domestic market, which we have started observing over the since the last financial year, and is continuing on. As you know, that the budget allocation for capex was increased to 10 lakh crores. So we are seeing very good demand in India right now as well. Having said that, on absolute numbers basis, exports have been consistently growing. We are present in 55 countries worldwide. So we don't see a challenge in the exports to continuously grow. Of course, we have booked this large BSNL contract, which is itself is about 2,500 crores. And because of that, there is a skew towards domestic in the overall order book.
Well, Sharan, you also mentioned that the focus of the company, apart from growth, of course, will continue on profitability, improving your profitability. What are those levers which you think can be pressed from current levels as well, where profitability can be improved reasonably in the next coming years?
Yes, absolutely. Bottom line continues to be a prime focus in the company. We have delivered an operating EBITDA of plus of 11% this year compared to less than 9% last year. And we expect that to improve in the coming years as well. This will be led by more and more export execution. As I mentioned earlier, we have seen close to an 80% increase in exports of approximately 400 crores last year to approximately 720 crores in the financial year that just ended. So with this export growth, we will continue to see margins improvement, and of course, in the overall demand improvement, we should see that effect on the margins. Also, better operating efficiency, better control of working capital, and stable commodity prices will also lead to the better improvement in margins.
And just quickly before I let you go, so margins, you talked about an improvement. The exit rate in FY23 was around 10%. What could it actually be in FY24? And if you can help us guide with a top line figure as well.
You should expect 11 to 12% EBITDA number from the company, which has been our historical trend. We hope to get back to that number very soon now in this financial year. And on the top line, we are confident of achieving a 25% CAGR growth over the next 3 years, thereby leading to close to doubling our revenue after 3 years.
Sharan, on that note, we'll let you go. Appreciate you joining us. So that enthusiasm and optimism from the management is also, reflected in the stock price, which is trading high by around 7%.